We will tell you the 9 income-producing assets that will help you to generate money and become rich very easily. Watch this video till the end because some of these assets might be known to you, but some would be really shocking for you. Now let's begin. Number 1. Savings accounts with high yields. These accounts are like savings accounts, but provide a higher interest rate. Market conditions affect the rate. Through 2024, high-yield savings accounts may earn over 5%. With a 5.75% interest rate and $1,000 in your high-yield savings account, you may make $57.50 a year if the money is accumulated annually. They provide flexibility without term limits. Your money may be withdrawn without penalty. Remember that withdrawing cash reduces profits. Interest is only generated on account money. Your $250,000 investment is secure with FDIC protection. Interest rates might change. If interest rates drop, you may move banks for better rates. Ask your bank about high-yield savings account alternatives if you want one. Online searches might reveal the highest-yielding bank. Start by establishing an account, transfer cash easily, see your assets grow, and enjoy passive income. Number 2. Money market accounts. These accounts combine features of both savings and checking accounts. Typically, they provide higher interest rates in return for maintaining higher balances. They generate passive income by ensuring an interest rate in particular on the funds in the account. For instance, if you have $1,000 in your money market and they offer you a 5% interest rate, you could earn $50 per year by keeping the money in the account and allowing the interest to accumulate annually, even more if it accumulates quarterly or monthly. With a money market account, you have the convenience of instant access to your funds and the ability to write checks. With FDIC insurance, your funds are protected up to $250,000. Providing an extra level of security. Interest rates can fluctuate depending on market conditions. If you're looking to open a money market account, it's worth doing some online research to find the bank that offers the most suitable option for your specific needs. Then, create an account, transfer your funds, and witness the growth of your money. If you want to know more amazing assets and ways to earn more money, then do subscribe to our channel and also press the like button. Number 3. Certificates of deposit, CDs. CDs are deposit accounts that have specific time periods and offer fixed interest rates. The duration can vary from a few months to several years. Upon maturity of a CD, you will be entitled to the original principal amount along with the accumulated interest. As an illustration, 1-year CDs are currently yielding approximately 5%. If you invest $1,000 into the account and leave it untouched for a year, you can expect to receive $1,050 at the end of the year, assuming the interest is calculated annually. It provides a risk-free return as they are FDIC insured and offers higher interest rates for longer terms. There is a potential risk of inflation, where the interest rate may not be able to keep pace with rising prices. If you're interested in opening a CD, it's worth exploring online to identify the bank that provides the most suitable money CD for your specific needs. It is important to carefully evaluate the potential risks associated with having your funds locked away, as well as the advantages of receiving a guaranteed interest rate. Number 4. U.S. savings bonds. These government bonds provide a consistent interest rate for a specific duration. Essentially, you are entering into a lending agreement with the U.S. government. There are 2 main types: Series E and Series I bonds, each with their own distinct features. Currently, the interest rate for I bonds is 5.27%, while E bonds have a lower interest rate of 2.7%. Series I bonds provide a safeguard against inflation. There are no state or local income taxes on earnings, although federal tax is still applicable. On the other hand, it offers relatively lower returns when compared to other securities. If you're interested in opening a U.S. savings bond, you can visit treasurydirect.gov. It is important to thoroughly research and gain a comprehensive understanding of the advantages and disadvantages. Next, establish an account. Choose the bonds that align with your needs and proceed with your purchase. You are now owed money by the U.S. government. Number 5. Corporate bonds. Private and public companies issue corporate bonds. When you purchase a corporate bond, you lend the firm money. This agreement includes regular interest payments and the bond's full face value at maturity. Corporate bonds often outperform government bonds. With other assets, corporate bonds may minimize portfolio risk. They provide safer, lower yield bonds and riskier, higher yield ones. Failure of a corporation might cost investors. You may acquire corporate bonds or bond ETFs via brokerage. Comprehensive study is needed to understand the issuer's finances and the bond issuance. Try financial news sources and business rating organizations. Industry specialists can help you choose the best investing approach, much like a financial advisor. Start by opening a brokerage account when ready. Select bonds that match your risk tolerance and financial goals. Purchase now. Your next step is corporate financing. Number 6. Stocks with growing dividends. These stocks are from dividend-growing firms. Existing, financially solid firms are prevalent. These equities combine dividends and capital appreciation. The regular dividend increase of these equities is frequently a sign of a solid, growing firm. The company's prior dividend distributions may predict a continuous quarterly income from dividend-paying stocks. It helps budget and plan. You may buy additional shares by reinvesting dividends, which can boost your investment's worth over time. Instead of being taxed when the asset is sold, dividends are taxed when received. Those in higher tax brackets should examine how this may affect their annual tax burden. Your major option for dividend growth stock investment is brokerage. Number 7. Growth stocks. Investing in growth stocks involves purchasing shares in companies that are projected to experience higher than average sales and earnings growth. These companies typically reinvest their earnings back into the business, which helps drive additional growth and expansion. Unlike dividend growth stocks generally do not distribute dividends. Instead, they provide the opportunity for significant capital gains as the company's value and share price rise. These stocks are frequently observed in rapidly expanding industries or innovative sectors. Investing in growth stocks has the potential to yield substantial capital appreciation, provided that the companies are able to fulfill their growth potential. Investing your earnings can result in significant growth over time, particularly in emerging sectors or cutting-edge technologies. Companies categorized as growth stocks are frequently at the forefront of their industries, shaping and influencing trends, which can result in elevated market valuations. Number 8. ETFs. Exchange-traded funds, ETFs, are funds for investment that can be traded on stock exchanges, similar to stocks. An ETF typically holds a variety of assets, including stocks, commodities, or bonds. ETFs provide a budget-friendly method to access a wide range of indices, sectors, or diverse investment strategies. Investing in an ETF provides the benefit of diversification, which helps mitigate the risks associated with individual investments. ETFs generally have lower fees compared to mutual funds and require a lower minimum investment. Just like any other investment, ETFs are exposed to market risks, which include risks associated with the underlying securities. Before diving into ETFs, It's important to first determine your financial objectives and how much risk you're comfortable with. Take the time to explore various ETFs and identify the ones that align most closely with your investment strategy. Number 9. Peer-to-peer P2P Lending. Peer-to-peer P2P lending lets people borrow and lend money without brokers. Through internet services, platforms link borrowers and investors. With this option, borrowers may borrow from individual investors at a mutually agreed upon interest rate. Now, you should know how you could get rich before your 50s, and for that, you must subscribe to our channel and watch the video appearing on the right side. We have discussed a few tips on this video, and with those tips, you could easily get rich before your 50s.